Hello, this is Brian Shannon from AlphaTrends.net. It is Monday, the 28th of July, 2008. The market closed and the S&P lost about 1.5%. Spiders were down $1.95, and as we know, the January and March lows had been broken last week, but then the market kind of came back below that Thursday and Friday, and today we saw a resumption of selling. Hopefully you saw on my blog at AlphaTrends.net earlier in the day I had shown this chart that says basically be careful here. The market was at 125.14. I said it looks like it could break down here, and if it does, it could lead to a quick and sharp move lower, and that's exactly what we did have happen as the market broke through some support recently near that 125 level, and kind of 124.75 really was the level that where the downside selling, really picked up here this afternoon. So now, on Friday, I had pointed out we had that 5-day moving average that had flattened out and had acted as resistance early on. I said that wasn't a good sign. It looks like this market might be setting up for another move lower, and in fact, that's what we had today. And that shouldn't really come as a surprise when we're in a primary downtrend like this. So it looks like perhaps we're going to head back down and test these lows from earlier in the month. Right now, that's still pretty far away, so we have to look at where we might stop along the way, but it seems as though the handwriting's on the wall. Right now, this prior level of resistance, maybe we get a little bit of a bounce in here, but I don't think it's enough to trade the long side on. Certainly this level here should be the important level of resistance up near 125. If for some reason somehow the market makes it back above 125, then I think you want to be careful with short sales. But looking at this shorter term time frame, there's really nothing here at all to suggest that that would happen. Maybe we get a rally back up towards 125, and then if it starts declining from there, then there's another opportunity to get short if you missed it today. So the path of least resistance on the daily time frame, on the weekly time frame, on the 30-minute, the 10-minute, on the 1-minute time frame is all lower. All these trends are aligned across multiple time frames. Odds favor further continuation of a trend. A trend once established is more likely to continue than reverse. I don't talk a lot about it on the videos, but I've been getting a lot of great feedback for the book, only available at this site here, which is technicalanalysisbook.com. Go ahead and take a look in there at the reviews. I've posted a lot of information recently to the bonus tab and some trade ideas, so go ahead and take a look at that. Those are some trading ideas and ideas that you can learn from, where I've basically narrated live trades as they unfold. So the S&P 500 clearly is in a downtrend. Looks like it's heading for here's a potential level where it might find some buying, and then 120. But the market remains in deep trouble here, and no reason to think that it's going to reverse anytime soon. The USO, the oil, here still in a short-term downtrend, or intermediate-term downtrend. Last couple of weeks, I've been talking about if you have been short, the definition of trend is lower highs and lower lows. Came close to violating that here late in the afternoon. I would say basically any further strength here, you probably want to cover your shorts. If you're short in there, it hasn't made that higher high quite yet, and we do still have the declining 5-day moving average. But with the longer term trend as strong as it is, I would think that it would be prudent to cover short positions if you're short in there. The Russell 2000 had been the leader in here, and as we saw last week, it came up to the level of prior support, where the important breakdown came from right in here in late June. And this market made it past this $68 level, ran up towards that declining 50-day moving average. And again, it's the direction of the 50-day moving average that is more important than whether it closes above it or below it for one or two sessions. The weekly time frame still troublesome, but of course this 425, I believe, this level has been where we've found support for this market. Maybe the next time it goes down there and breaks down, but that's obviously too far down the road to really take seriously at this time any consideration of that. We are coming down to this level here on the daily time frame, which is just above that 68 level. So we can take a look. We've got basically right about that 68.50 or so. I think below 68.50, or I think that the market looks like it's headed down towards that 68.50. Then maybe you get a bounce up towards this level here. This is the important support recently. Any bounce towards there, and then a sell-off. Maybe we continue down towards that 68.5, and then we have to reassess whether the market can hold on in there, or whether we're going to get a larger breakdown back into this range and come back and test that 66 and then 64 level for further downside. Right now, it's too early to tell, but like I said, the way to play this is with this TWM. The TWM is the double inverse ETF for the IWM, and this market was up 3.2% today. So that's the way that you want to play it if you're going to take advantage of further downside in the IWM. The semiconductors, again, these guys look like they're headed for at least a test, if not a and these are actually closing lows in here. We haven't seen the market close at these levels, the SMH. So you can see we haven't seen a close below at these levels since really. I guess you got to go back on the monthly time frame, and I got to change the scaling in here. But we haven't seen closes in this area since basically we're back in. Looks like about maybe May of '03. So this market, the semis continue to deteriorate, and that again is reason for concern about the NASDAQ 100. People talk, tech, but what is technology? Semiconductors are technology. I made that point on Friday. So the Qs are still obviously in a downtrend. We've got a declining 50, 200, a 10 and 20-day moving average. They're all declining, saying the trend is lower. We had been looking at the potential for this inverted head and shoulders pattern to develop, but I'd warn that you never want to get involved early. You want to wait for it to materialize, and there wasn't really a great likelihood that this market was going to go past that 46 level. But if it had, that's just a scenario you want to be aware of, because it would have probably led to a squeeze higher up towards the 50 or 200-day moving average. What could have happened is now in the rear view mirror, because it hasn't happened. And we've clearly broken down here instead. We're back below the 5-day moving average. That's starting to decline again. It broke these lows here from early last week, where it looked like the market was recovering, and now it looks like it's headed back down towards that 44 level. Again, 44 to 46 has been the range in here. I think a breakdown below 44 could be something that leads to a further unravel and perhaps new lows in the NASDAQ 100. Not right away. We'll still have to deal with some of these levels in here before it was obviously to continue down towards these lows in here rather. But the path of least resistance obviously remains lower. The odds are against long trades, except for the quick scalp trades, and we remain in a tricky, volatile market with earnings reports out, news from the government every day, and the banks and all that. So just continue to trade it aggressively and honor your stops.